Hi, I'm Kara Murphy, and this is Money with Murphy. The last few days have been a little rough for stock investors. Relations between the US and Ukraine faltered, and tariffs against two of our largest trading partners, Mexico and Canada, are expected to go into effect. With rising policy uncertainty, many stocks, including some market bellwethers, have taken hits. But before you get too glum, it's worth noting what is held up in the market, namely bonds. While the Nasdaq has declined 5% year to date, the Bloomberg United States Aggregate Bond Index is up 3% over the same time frame. While this is a short period, it's a helpful reminder of the importance of owning different types of assets. This recent strength in bonds comes after several years of disappointing returns, which left many investors somewhat disillusioned with fixed income. Bond performance was particularly disappointing in the year 2022, when stocks suffered steep declines and bonds also fell, failing to cushion portfolios as we've come to expect them to do in bear markets. But before discussing why bonds are doing well now, it's helpful to remember why they performed poorly in the recent past. So beginning in 2020, bonds suffered a triple blow: low starting yields, sharply higher inflation, and tightening Federal Reserve monetary policy. In fact, the Bloomberg Aggregate Bond Index, which measures various types of bonds, is still down 3% from 2020. So why are bonds performing well now? Much of that answer is essentially the inverse of what didn't work in the recent past. Inflation, while still higher than the Fed would like, has come down substantially. That has allowed Federal Reserve policymakers to cut short-term rates modestly, and as those rates have declined, bond prices have gone up. And finally, bond yields were starting from a much higher point than they did in 2020, providing investors with additional income. Another key difference today compared to 2022 is starting yields. In early 2020, that Bloomberg Aggregate Bond Index had a yield of just 2%. Now that same yield is nearly 5%, a full 2.5 times higher. A higher starting yield means bonds can offer more protection if interest rates continue to rise. More recently, rising stock market risks have made bonds look more attractive by comparison. For instance, tariff concerns, rising geopolitical risks, new entrants to artificial intelligence have all rattled some stocks. And often during times of turmoil in the stock market, bonds can perform better. While both bonds and stocks fell in 2022, that experience is more the exception than the rule. During many rocky market periods, bonds have actually protected portfolios. Now, this is not to say that bonds are without risks. Inflation remains above the Federal Reserve's 2% target and has shown signs of reacceleration over the last few months. If inflation continues to rise, longer-term bond yields would go up, which in turn would hurt bondholders. Similarly, if the Federal Reserve begins to raise interest rates, that would also provide a headwind for bonds. So where does that leave bonds in a portfolio? Given where yields are today, their ability to help cushion portfolios during stock market volatility, bonds remain an essential part of a well-diversified investment strategy. However, it's important to position your fixed income investments wisely across different maturities, different risk levels, based on your financial goals and the risk present in the market. So until next time, invest wisely and live richly.